Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello, and welcome to the Stock Play of the Day. Today's stock is NVDA. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Kelly Cox will not be joining me today, so let's just jump right into it. We're going to start by looking at the chart of the S&P 500 index. I'm showing it right now. We are seeing a lot of chop in the marketplace. So it's been talked about by all the analysts, just trying to decide where we're going to go. Are there inflation concerns? Are there not inflation concerns? Is the 10-year bond rising, or is the 10-year bond yield falling? And as of today, the 10-year bond yield is down a little bit, which has kind of helped out with the concerns about inflation in general. And we see here in the S&P 500 index that we see a lot of chop. As a matter of fact, if I highlight the 20-day moving average here on my chart, we see that it's basically became a flat line. If you were in the doctor's office and you saw this, you'd be a little bit nervous overall, right, on the EKG. But in general, it just means the market just cannot decide where it wants to go. And what we've seen here more recently in the S&P 500 index is that the market, and this is a daily chart, just going back a few months in time, is trading between this 20-day moving average and the 50-day moving average. As a matter of fact, one thing to kind of highlight here is that we came down and touched the 50-day and got a bounce off it, which was just in general a good sign for the market overall. But we came right back again and touched right away, which that's a fairly quick touch of the 50-day moving average in general. It just usually, if you get a little bit where we come down, we hit the 50-day here, you get a little bit longer time before it will come back and hit that. But we've also been talking about the 200-day. We've been extended over the 200-day moving average for quite some time. So a little bit of a pullback wouldn't necessarily be a bad thing for the marketplace overall. But now the market has changed its mind again. And we see just drawing this short little trend line here that I'm trying to highlight without getting that box in there. And we see, based off of this most recent move, that we've actually broken out of that trend line. And we jumped above the 20-day moving average. And now we're trying to set all new highs again in the S&P 500 index, just in general. If we pull up the NASDAQ chart, guess what? Very similar chart. In the NASDAQ, we did have the breach of the 50-day moving average. But if I draw the trend line on the most recent move, once again, the last 3 or 4 days, actually, you could call it a breakout to the upside based off of the trading levels just recently in the NASDAQ index and all the stocks that have been driving the NASDAQ, which have been very weak. The FANG stocks have been very weak recently over the last month or two. And actually, a lot of them have been dragging the market southward, including the S&P 500 index. But now, once again, we did that little breakout above the 50-day moving average. It looks like new highs are in play. Not saying that we're going there. I'm just saying that that is some possibility. Now, right here, right at that 13,750 level, right there, if I kind of highlight it with my crosshairs on the chart, might be a little bit of resistance overall. But then we get back into that same trading range before we start approaching that new high in the NASDAQ index. All right. So overall, markets are looking a little bit more bullish today than they were last week. And now let's go in and take a peek at the stock. We're going to look at NVDA. Now, NVDA, we actually talked, Kelly and myself talked a little bit about NVDA last week. We were thinking about making that the stock play of the day. We went with home builders instead. And that trade has turned out all right. We were looking for a little bit of weakness in home builders, hopefully able to get long an ETF. We didn't have an overtime last week because of things that arose overall. No great excuse for it. So the home builders trade is kind of panning out. We're hoping to be able to buy the stock at a lower price, and we talked about a cash secured put in it. Now in NVIDIA, it's a much more volatile play overall, but the volatility of NVIDIA option contracts hasn't skyrocketed recently. So there's a couple of things that I want to talk about with it. NVIDIA has recently announced a 4-for-1 split. Now, on July 20th, it's going to be trading at the lower price. Basically, take the stock price, divide it by 4, and that's the price that NVIDIA is going to be trading at. But before we get there, we're going to have earnings. So as of the 26th on the close, NVIDIA is going to be announcing earnings. So I'd like to do a play kind of based off of the longer term and the 4-for-1 split. The stock has the news has already been out there, and it's already made a very strong move to the upside. But if I look at the NVIDIA chart, we see that we haven't set a new high. Now I'm going to highlight once again with my crosshairs here an area of the chart that's very interesting. Right here is where we came up and hit a resistance level to the upside, had a little bit of a drawdown all the way down below the 200-day moving average. Underlying stock comes roaring back, gets up to that little area, pauses for a second, and then breaks out. So now guess what? We're right back to that area again. And the 4-for-1 stock split announcement is giving a little push, a little bit of a breakout to the upside, looking to try to set some new highs in general. So we have earnings. I want to manage our risk using options. And then I'm going to talk about what we might want to do after earnings, how you might want to approach the trade. But first of all, let's go in and look at, well, I think I'll bring up the options playbook. Let me jump over there. The trade that we're going to look at today is a long call spread. So I said we're semi-bullish in our little, if you saw our little title slide, semi, S-E-M-I, bullish on the NVIDIA stock today going into earnings. Now, a lot of things are happening with NVIDIA. A lot of things are happening with the chip shortage. NVIDIA also is trying to wane people from using their chip because it's so good, their gaming chip in general, at Bitcoin mining. And so all of a sudden, that's the hot trending topic, Bitcoin mining. Bitcoin has dropped precipitously over the last 2 weeks. It's made a little bit of a rebound today, but they've found out that the NVIDIA chip in general is one of the better chips to use for Bitcoin mining, and they are conscious of this. So interesting enough, they're a company that wants to, I guess for lack of a better term, dummy down their chip or make it less useful for Bitcoin mining. So they're trying to wane demand so that other companies and in particular gamers, those chips will be available to them. So just kind of interesting that they have so much business right now going on that they can't keep up with it. And they don't know how long this chip shortage is going to continue. One of the biggest things about the chip shortage is that it takes, especially on the very high demand chips, the large data chips take months to develop. So they have talked about this problem. Even the government has got involved because they kind of think of it as a security issue if we can't get chips to power some of our computers that try to keep us safe and sound in the marketplace. So government's getting their hand in it. But overall, there's no doubt that there are demand at this point in time for semiconductor chips. And one of the most popular ones and the leader in this space is NVIDIA. Okay. So maybe we missed the boat a little bit by not talking about it last week before they announced their 4-for-1 split, but we have earnings coming. So how would I play this, knowing that we're going to be talking about earnings and also knowing that we have a 4-for-1 split coming? So on these situations, I want to pick a direction. The stock has made a strong move up, little bit of a breakout to the upside. Who knows, though? I think earnings are obviously going to be more of a driver than the technical analysis is over this week, of course. So I'm going to look at a long call spread, a bull call spread in NVIDIA. And I'm showing that right now inside the options playbook. We're going to center the stock basically right below strike A. So strike A is going to be a little bit at the money, then we're going to sell a little bit out of the money. And we're going to manage our risk with this trade in that we're going to risk about $1 to make $1.50, and then we're just going to let it ride. So we're giving ourselves more upside than downside if the market does go up. And we're saying, okay, this is going to be an all or nothing trade, but because we have this the profit and loss on our side, when you're thinking about doing these trades around these speculative in the news stocks, this is one way that I just like to manage risk. Now, the biggest thing is you don't want to overdo it. You don't want to use the leverage factor and buy a boatload of these things, long call spreads, just because you can, right? Manage your risk, understand that this is risk capital, and basically at the end of the week, you'll know, did you make $1.50 or did you lose $1? Now, extremely speculative. And as always on the stock play of the day, we want to make sure that this is not, that this is not a recommendation. We don't know what's going on in your portfolio, and this is a very speculative play. But I always like to talk more about not the actual outlook for the underlying stock, but based off of the conditions, the pricing of the option contracts. Is it an expensive stock? Do we have high volatility, high implied volatility in the options? Is there an earnings announcement? Is there something that is affecting the price of these option contracts more so than the normal market conditions? And if so, how can I adjust my option strategy to try to match the pricing conditions in the marketplace? And today we're going to do that with a long call spread. So let's run to the Ally Invest option chains. And we see today that it's down. It was up a little bit. And the semiconductors overall, when NVIDIA announced their 4-for-1 split, it actually drove all the semiconductors higher, a lot of the semiconductor companies higher. We see that they're all down a little bit today, and that's maybe a little bit of fatigue from the big run up that NVIDIA had last week of over 25 points. But now we see here's the earnings date, 5/26. Here are the different expirations that are available. And as always, I like to check this by just looking at the option chains. If the earnings date says 5/26, what we should see is a drop off between this expiration date and the June 4th expiration date, right? So this would contain earnings. May 28th is when it expires. And we see that that's trading on the at the money issue, on the at the money strike, looking at the call side of the chains. We say it's trading at a 63% implied volatility. And then we run out to the June 4th expiration 10 days away, and we see that at a 44% implied volatility. So yes, there is a waning of implied volatility. We see that 5/26 is probably the feasible date. Just always like to double check it. You can also double check it by just going to Investor Services at NVIDIA's website overall, and they usually have their earnings announcement there. But with that said, we're going to go a very short move. NVIDIA's at 623, so the most at the money option contract is the 622.50, 623.42, 622.50. And if we just look at buying the long call and buying the long put, we're looking at 15, and we'll call this 40, we'll call it $30, right? So around a 30-point move would be the expected move if we were looking to buy this. The market is saying that because of this earnings announcement, a 30-point move before the May 28th expiration is feasible. That's a feasible move. If you think it could move more, then you're betting the over as far as the options market is concerned. If it's going to move less, you're betting the under, just like you would on a football game, just in general. That's the concept of what the expected move is setting by just looking at what if I bought the long call or I bought the long straddle, what type of move is expected after this earnings announcement. Okay, so with that said, let's go on in and look at the strategy. And like very, very speculative, very, very short-term trading. So I'm going to manage my risk by the width of the spread and how much I'm willing to pay. I want to have more upside than downside. I'm only going to go 2.5 points just because this is a fairly conservative show that we talk about on Stock Play of the Day. You want to go 5 points wide You want to do the 625 strike, and we'd be buying. We just click the little checkbox over here once for a buy. We click twice for a sell. If you want to buy the 625 and then sell the 630, that's okay. You go a little bit wider, you're going to spend a little bit more. We're going to have a little bit more upside. Now, if I just bought the 625 outright, you're looking at spending for a 3-day option contract $1,410 if you paid the ask. A little too rich for my blood. So I don't mind doing a spread in the fact that we have weekly expiration makes it more feasible to do a spread around an earnings report. Why? Because we're buying one expensive option that's trading for $14. That wants the market to go up. And we're selling a very expensive option on top of it, cheaper, but expensive relative. And that wants the market to go down. So they kind of fight each other. So what's our best case scenario? That the market continues on up and that all of this premium that we're selling, and I'm going to circle it on the bid side, decays. And we get a lot of intrinsic value on our 625. The time premium comes out of the 627.50. We make our $2.50 or as much of it as we possibly can. And we paid $1 and we were able to get out for $2.50 overall. So this is the official paper trade. I'm going to put it in the right rail right now. And so once it's in the right rail, it becomes official. Oh, the market's moved a little bit on me. It was $1. Now it's $1.10. I was kind of hoping it would stay at the dollar. I like that risk reward a little bit better. Well, we'll just run with it. So now we're paying $1.10 to be able to sell this for $2.50. So instead of making $1.50, we can only make $1.40 on the upside. But that's the risk of doing a stock play of the day live, right? Is that you're using live markets. So that will be our official paper trade. We're buying to open the May 28th 625 strike call, and we're selling to open the May 28th 627.50 strike call. All right, so now we're going to go and look at the profit and loss graph, but I want to highlight that I am here to answer your questions today. And this stock play of the day without my co-host, Callie Cox today, unfortunately, she couldn't make it. But with that said, we've really made it a lot more option focused. So I picked a stock that's going to be announcing earnings, been in the news quite a bit. And we're going to talk a little bit further about, well, what happens after earnings. But before I get there, please put your questions in the chat box. We have plenty of time to chat about them today, just because Callie did not do her segment overall. All right, so here's the official paper trade. You see that right now. I'm going to close that box, and then we're going to run down and we're going to look at the profit and loss graph. Okay, so expected move around a little less than $30. Market's at 622.50, fairly close to that. It's highlighted by this gray bar right now. That's a live price of NVDA. We see we're looking for a move to 627.50. We're looking at for a 5-point move. If you wanted to be bearish, you think that the run-up was overdone, you could duplicate this trade on the opposite side. You just want to do something that's fairly close to the money. And I'm looking more so at what I'm willing to risk. I'm willing to risk $1. I want to make sure that I can get enough upside to make that worth my while. Risking $1, hoping to make $1.50. In our instance, it's going to be $1.10 to make $1.40 because the market has already moved on us. All right. So, so right now, as you see, the colored line is highlighting a very, very flat line. It kind of looks like the 20-day moving average in the S&P 500 index. But at expiration, what has to happen is that line has to morph into the dotted line. Eventually, by Friday, this colored line that's highlighting our profit and loss graph right now will have that volatility decrease overall, and then we'll see this underlying stock, this colored line start morphing into the dotted line overall. All right. So I'm going to open it up for questions. Joanna just did a little shout out from Capitol Heights, Maryland. Thanks, Joanna, for that. If you have any questions, please put them in the chat box. I don't see any right this second, so I'm just going to move on with the second part of the trade. And if anything pops up, I'll try to answer it. Okay, now, one of the things about NVIDIA that's kind of interesting is that volatilities, even though we've had a very volatile move in the underlying stock, the implied volatilities haven't really skyrocketed. We talked a little bit about this in Coinbase, which is symbol coin, and we did end up getting that volatility in coin overall. So now we're running in for a 4-for-1 split. Volatilities, if they do come off a little bit, how might I want to play the trade? Well, you can do a couple of things. If you wanted to buy this going into a 4-for-1 split, 100 shares of stock is going to be fairly expensive, right? $63,000 plus to do, or six. Let's if you want to get it exactly. Where's the underlying stock at right now? $62,208 is what we're talking about. You're going to buy 100 shares of stock. I don't mind going a little bit further in time. Now, the split is on July 20th. That's when it's going to be trading. Basically, you take the stock price divided by 4, and that's where it's going to be trading at. But you can buy an in-the-money option contract relative to that split. I would wait till the earnings are done. And if you want to be bullish on the underlying stock, you can buy an in-the-money call option. Go a little bit further out in time. You can either make it expire before that split, which would be July 16th, or if you want to ride it into the split, you can do the August 20th, and those are the expirations I would look at. And I would think about buying about an 80 delta option contract. We should see vols come off. Market's fairly liquid in this underlying, so not that's one of the biggest concerns about buying deeper in the money options. But it's just an alternative to buying that 100 shares of stock after we got the big news event, and it would be a different way to play it. Now, you could obviously play it bearish too. You can think, well, the run-up was a little bit overdone and just go a little bit deeper in the money on the put side. But right now, we're going to do a speculative trade based off of earnings. After the fact, it would be a more directional trade, a more of an investing strategy to go deeper in the money, go out to the expirations that surround the actual stock split and buy something a little deeper in the money. Okay. Kristen is asking, I might change this one up a little bit, like, why did you choose the expiration? Well, I'm going to choose this shorter term expiration for this particular strategy because of what I mentioned in that this is a high price stock. We got fairly high implied volatility, and you need this option contract to go to zero as fast as possible if you're correct on your forecast. Now, it also means that if you're incorrect, this option contract, the one that you're buying, the 625 strike option contract, is not going to help you as much, right? Because time decay is going to hurt that option contract. And that's why I say this is really an all or nothing trade. We're either looking to make our $1.40 or lose our $1.10. And there's really no in between. We expect this underlying to move. It could feasibly land somewhere in between these strikes, but the odds of that happening are extremely low overall. All right. Now, why would I go out to the further expiration? And I'll just run with this from Kristen. If I look at, okay, so here is the split on the 16th. We'll click on August, July, and August. Okay. And we're going to run out further in time. Okay. Then I got to go a little bit down in strikes. I'm going a little bit off the cuff here. All right. And if we do that, if you're looking at a fairly higher delta, so 87 days out, you could come in and this is a 61 delta. I'm sorry, I'm going to go a little bit more. I want a little bit more delta than that. Let's go down to the 562 strike. Okay, that should get us something. 565 should be close. Okay, 565, that's a 90. Okay, 570. Here we go. 585 strike. So here's the June 4th. Oh, not June 4th. That's why the strike was there. That's why the delta was there. Okay, so 565 strike, we got an 80 delta. This is July 16th expiration. This means that you're going to ride it into the split. We have a fairly decent market, like I said. Now, this isn't the stock, realize, and this is honestly, to be blunt about option trading, buying in the money option contracts. If the bid-ask spreads weren't usually $1 wide or more, you would see a lot more people buying these 80 delta options. This one delta happens to be 77 than the underlying stock, and managing their risk this way. So this would be, let's call this 71. That means $7,100. That would be the maximum that you could lose on this trade going into the split. We're going to ride this one out to the July 16th expiration. And this might be a trade, and this might come off a little bit after earnings. Applied volatilities aren't bad at 38%, but if they came down a little bit more, it means a little bit more of a discount relative. Just don't know where the underlying stock could be. So this might be a viable solution the day after earnings if you want to get bullish on NVIDIA going into their stock split. Now, if you want to ride it past the stock split, you go beyond the July 16th expiration and you look at the August 20th expiration. That strike has a 73 delta because you're going a little bit further out in time, and that's trading for around $81, $80.95 or $8,100. But you can work this trade a little bit, see if you can get a little bit better price on it, and going that gives you 87 days. And then after the split, it's going to do a 4-for-1 split. So you'll have a different option contract. You might end up with just 4 options in your account as opposed to 1. And the price of the option contract gets split in half. Depends on the terms and conditions of what the Options Clearing Corporation is going to do. Either one is okay. Nothing wrong with that. It's not a funky 5-for-3 or 7-for-9 type split. It's just a straightforward 4-for-1 split. Makes it pretty easy in the options marketplace overall. And these are 2 interesting trades that you can do on NVIDIA going into not only earnings, but also into the stock trading after the 4-for-1 split. All right, I got one last question, and I got a couple of minutes here to answer it. So Wayne gives me one last question here. Brian, on the current expiration, would you go deeper in the money and on the buy leg and closer to the money on the sell leg to increase our delta impact? No, Wayne. I understand. In other words, would you straddle the stock price more? I don't think we need to, Wayne. I'm more worried about managing the risk by the cost. 30 points is the expected move. So I definitely think this underlying stock could probably move 15 points. Now it might go up 15 points and then come slamming back down 15 points. But I think that you're going to get a decent move. So I don't even mind being, an extra 5 points up in strike. I might actually adjust it because the market has moved against it. Now we're paying 110 as opposed to paying $1 if we could fill at that midpoint price. So no, not necessarily on this underlying do I want to just straddle the stock price with my long call spread. I want to manage my risk. I want to make sure that I am paying less than I could make if I was correct on my forecast after earnings. All right, we got one more. John M. is asking, would a regular call or long call spread be more appropriate going into the split? Does the split complicate closing out the contracts? Sometimes if a stock does an odd split or it's a merger or acquisition, the option contracts will become harder to close out because they will be a non-standard option contract. A lot of times on a 4-for-1 split, and I have to admit, I haven't actually pulled up the OCC, the Options Clearing Corporation document to look at exactly how they're going to handle this split. But a lot of times when it's a straightforward 4-for-1 split, 2-for-1 type split, it doesn't make the contracts as illiquid as a, like I mentioned, 5-for-3 stock split or some type of merger acquisition, those type of things. Now, I'm going to throw out a number that's been around for a long time, even since I worked at the Chicago Board Option Exchange, which was over 20 years ago now. But 888 options, 888 options. Great people that work on a help desk for the Options Industry Council. So if you have any questions about what might happen to your option contract after the split, that's all they do all day long is answer those type of questions. So it's a great resource for you that's provided by the actual exchanges that trade options in general. All right, so great questions. Thanks for coming. We will be here this Friday for a stock play of the day. We'll do a stock play of the day overtime. So please make sure you click subscribe and ring the bell. And then Monday will be a market holiday, Memorial Day. And then on Tuesday, we do plan to be back to have another stock play of the day. And hopefully I'll have my colleague, Callie Bell, will be back, or I'm Callie Bell. Callie Cox will be back. I combined Callie and Lindsay together. I didn't mean to do that. But Callie Cox will be back with us this Tuesday at noon Eastern time. Once again, click subscribe, ring the bell, and we'll see you then. See you this Friday for the stock play of the day overtime. Thanks for coming, everyone. It's a really good show, actually.